As investors deal with increased uncertainty surrounding U.S. tariffs and politics of trade, there's another concern that has been emerging: the rise of U.S. government debt. So what has this meant for the corporate debt market? Benjamin Chim is Managing Director and Head of Credit at TD Asset Management, joins us now. Ben, thanks for joining us.
Thanks for having me, Anthony. Appreciate to be here.
All right. Well, we've seen in the markets about fears about U.S. government debt. How's that playing out for corporate bonds? And are corporate bonds the new safe haven?
Yeah, you know what? It's pretty rare to have a thought or to think through the possibility that a company, as a borrower, could be riskier than the government that it pays taxes to, the government that drives, the rules and regulations to which they operate. It's not that it hasn't happened. It does happen from time to time in the emerging markets, right, where you get countries there that have quite a bit of political instability, quite a bit of regulatory instability. But for developed countries, you always have a fairly long-standing traditions or long-standing regulations, long-standing legislation that those frameworks have stood for a while and, are supportive of a more stable political and economic regime. And you also have for, developed countries, the ability to flex up and down their taxes, to flex up and down their costs to really kind of meet any kind of obligations that they have if their backs are up against the wall. And you can take those kind of developed market characteristics and certainly apply that to the United States. And I would add that there's the added strength of the fact that, they have quite possibly the richest and strongest taxpayer base, in the world, as well as, the world's reserve currency. And, certainly the status as a reserve currency could change. We're not expecting that to happen, but it could happen. But even if it were to happen, the U.S. currency itself, given where they are as a trading partner, not really going to be challenged significantly. And of course, there's going to be consistent demand for U.S. assets. So really all of that is to say that I don't envision a situation in the near term where, or even in the longer term, where the U.S. credit quality moves down to a level where it's similar to your average investment grade corporate bond. So it's something in the A rating category. Just all those characteristics we talk about just give the U.S. economy too much, and the U.S. government too much strength to see that happen. Now, that being said, if you were going to look at returns and the volatility around returns for corporate bonds compared to government bonds in the last couple of years, you kind of be hard-pressed not to think that corporate bonds were safer. And then when you think about the earnings backdrop going forward, looking to the future, and of course you talked about the large budget deficit and all the funding that needs to happen, there is a decent likelihood that that relationship will continue, that we'll see still better returns from corporate bonds versus government bonds and less volatility within those returns. And there's a number of things that I can think about that I think really support that. The first is that I see fundamentals in the corporate bond space as still quite supportive, and that's been the case for the last couple of years, and that continues. And what I mean by that is two things. The first is, when you think about economic growth, we're sort of in this Goldilocks backdrop, right, where it's not too hot. And when it's too hot, you always worry about, central banks hiking rates and, the cost of debt and cost of interest rising. So it's not too hot, but it also is not too cold. And being too cold means risk of, heading into a recession and risk of corporate bonds defaulting. When growth is sort of in that 0 to 2% range, that's kind of the sweet spot, I would say, for corporate bonds and how they perform. You don't need strong growth for them to meet their debt obligations. And that's kind of where we see, and I see growth kind of continuing for the near term and for the foreseeable future. That, I think the fundamental backdrop from that perspective is solid. Then, of course, you have the fact that corporate bond balance sheets are in pretty good shape still. The cost of debt, the interest costs are high. And so for companies, borrowing to fund growth, borrowing to fund some kind of project is pretty expensive. It's a pretty difficult decision. So we haven't seen a lot of companies in this past cycle, really extend themselves, get too aggressive to borrow to aggressively try to fund growth. And because of that, a lot of companies and the corporate bond market as a whole has quite a bit of wiggle room to withstand, say, volatility from the economic backdrop and earnings or volatility from interest rates. And that is supportive, again, for corporate bonds and their fundamentals. Then you got the technical side of things, supply and demand. I talked about the fact that companies haven't been borrowing a lot, so the supply levels are fairly high, but not out of normal range. And then when you talk about the demand side of things, we have found that Canadian corporate bonds yielding 4%, U.S. corporate bonds yielding 5%, have been levels that have attracted pretty good investor interest into the asset class.
Okay, let's talk a little bit about equities. You've given us that backdrop of corporate bonds versus government bonds and the fundamentals for corporate bonds. How do corporate bonds compare to equities? How do they stack up?
Yeah, it's a really interesting backdrop right now for equities. Right, we've seen a very strong retracement from the volatility, the trade-related volatility that we saw in April. We're now at a point where the bulk of the developed market equity indices are getting pretty close to their all-time highs. And what that means when you think about growth, you got the Dow and the S&P at multiples of low to mid 20s. You got the TSX at sort of a 19 times multiple or something around there. There's quite a bit of growth that needs to happen for the equity story to play out and generate strong returns. Now, that isn't to say that it's not going to happen. I think there's a lot of good reasons to be constructive on the equity markets and think that things will continue to be strong there. There's good tailwinds. You talk about technology and AI and all the spending around that. Support in terms of, for the real estate market, in terms of, data center builds outs or the power markets and the consumption that's needed for all this technology. And then, possibly, tax breaks, regulation, deregulation coming down the pipeline as well. So, the upside for equities is still there. But I would argue that with all the stuff that's happening on the trade front, all the uncertainties around tariffs, that the downside probability has also increased a little bit. So maybe it's going to be a little more difficult to achieve those growth expectations that the equity markets are pricing in right now. And so I think that's where corporate bonds really kind of differ from equities in that you don't get the upside. Of course, your returns are largely sort of limited around what your yields are. But you also don't have the downside risk because I talked about that Goldilocks, not too hot, not too cold. You only need enough growth to cover your interest expenses, to cover your investment spending or your maintenance spending, to have investors comfortable enough to continue to fund you, to continue to refinance their debt. And as long as that's the case, then your return expectations for corporate bonds and investment corporate bonds specifically is likely to play out.
Okay, let's talk geographies. Where are you seeing some value there?
Yeah, I talked a lot of good things about corporate bonds. I would say probably the biggest concern that we have in the corporate bond space, particularly in North America, Canada and US, is the fact that credit spreads or credit risk premiums are at fairly tight levels, right? And we're pretty much at the tightest level we've seen in the last 5 years. So we've completely retraced, just like the equity markets have in investment grade credit spreads. So we're about 88 basis points in the US, about 100 basis points, or I guess roughly 1% in Canada. And so what that means is there isn't a lot of upside to the investment grade corporate bond markets right now, as there's not really much room for things to get stronger. There also, of course, is not a lot of recession risk priced into that because we're trading at the tight levels right now. So where we are thinking has a little bit more of value and it has a little bit more opportunity is in European credit markets. There, we haven't quite seen spreads retrace to where we were at the beginning of this year, so there is some upside to go from spread tightening. But I think just as importantly is, you've heard a lot about, fiscal spending in Germany. Seems to be a renewed sort of focus on growth for the economy, and when you see that, that speaks well for corporate bond risk premiums and them tightening further. And then you have, overarching all of that is, the technical backdrop where, since 2020, there has been a lot of capital flows, investor money going from Europe to the US, with everything that's going on in the trade front and the fact that hedging costs for the US dollar have really risen. There isn't as much of a compelling reason for European bond investors to be in the US market. So we've started to see a little bit of movement back to Europe. It hasn't happened in that much of a material way yet, but we think more of that could come going forward.
Okay, and finally, let's move beyond investment grade. How about high yields? What is the general outlook there?
Yeah, so high yield, similar to the European market, hasn't fully retraced from the sell-off that we saw in April. The caution there around high yield is the fact that most of that lagging, most of the lack of retracement has come from the lower quality parts of the market. So while we think the yields and all-in yields at high yield are, can give you a really good income. We talk about 7.5% overall. You have to kind of keep in mind that there are lower quality parts of the market that are trading off and haven't fully recovered, and rightfully so. You know, when you think about some of the factors that are impacting the economy or some of the concerns around growth, it really comes down to, you know, how are companies going to adjust to, you know, their trade flows, adjust their cost base to, you know, a higher tariff, potentially higher tariff backdrop, and then how is the funding market going to react to that? And weaker credits, single Bs, triple Cs, have much less room to maneuver in those kind of situations. So, you know, there's some caution around that part of the market. If we do see, you know, things normalize on the growth front and growth start to be strong again and actually exceed what people expected, those parts of the market will do very well, and I think the high yield market itself will perform well. But you know, we're at a bit of a crossroads still right now.